Good morning, class, and welcome to your financial market course. I'm Mark Gibson Manawis, and I'll be your instructor for this subject. So today we'll discuss about introduction to financial market, and then also later on we'll touch about the introduction to investment, your portfolio management, and we'll also try to differentiate investing to trading. So, but before that, let's define what a market is. So by definition, a market is a venue where goods and services are exchanged. Now, a financial market is a place where individuals and organizations wanting to borrow funds are brought together with those having surplus of funds. Now, the key things that you need to understand in a financial market is basically this is a venue where two organizations or individuals meet with the intention to borrow funds. The other party's intention is to lend money. And remember, and then later on, we'll check or we'll define who are these provider of funds and user of funds. For that, let's talk about the importance of financial market. Obviously, we would like to have a smooth flow of capital between providers and users of the capital. And it also promotes economic growth, and the economies with well-developed markets perform better than economies with poorly functioning markets. Again, um, since we're talking about the economy, basically the principle behind is that government continuously establishing laws and regulations to uh, make sure that financial markets are following those rules and laws governing them. Now, who are the providers and user of funds? Basically, when we talk about providers, these are, again, organizations and individuals who have surplus funds. No? So imagine yourself having surplus funds. No? Of course, you would like to invest it into, uh, say, say, investing opportunities for main reason or main intention to get more out of that surplus funds in the form of return. No? So it could be interest or it could be a capital appreciation. Now, who are the users of funds? Again, earlier when we define the financial market, there are two parties involved. You know? So the providers of funds and the user funds. Users of funds can be borrowers or corporations needing funds, demanders or users of capital who need funds to finance their investment activities. Now, these people, these organizations, they are willing to pay a rate of return on the amount they borrow or receive. No? So if it is a regular loan, no, say for example, John uh, would like to avail of bank loans. So John in this example would be the user fund, and then the bank would be the provider fund. Now John, aside from paying the principal, would also pay for interest. No? So that's the rate of return that is willing to pay for the equivalent amount of money that he receives, no, from that loan from the bank. Now, from the point of view of the bank, of course, the bank charges, well, number one, they charge different bank fees, no? They charge different bank fees, and then also interest from the loan. Okay, so how is capital transferred between providers and users? So there are two different ways. So number one is via direct transfer, and then secondly via indirect transfer. So let's discuss direct transfer first. So indirect transfer, basically the user funds, it's between the users of funds and providers of funds. No? It's simply directly transferring money from the provider funds to the user funds with the intention, of course, of receiving dividends or receiving interest. No? That's point of view of the providers. No? And then in terms of the users of funds naman, it could be in the form of capital appreciation and also payment of interest. No? So I think this is self-explanatory. When we say direct transfer, it's just between two parties. No? So it's between the user and the provider of funds. Now, let's see what indirect transfer is. No? So indirect transfer, there's a third party involved. So in this first example, we have the investment banks. So there's no direct transfer between user funds. In this example, there is intermediary party or third party, which is an investment bank. But let's try to define what an investment bank is. So investment banker, to originate securities issues negotiation between the officers of the issuing firm and officers of the investment bank. They also underwrite the issues by guaranteeing their sale in the primary capital markets. They manage the distribution of these securities to the ultimate investors. Members of the underwriting syndicate will form a selling group comprising of dealers that will reach the ultimate investors. And the investment banker, they also advise their corporate clients on long-term financial matters. Now, what are the examples of investment bank? No? So it could be also a commercial bank, but take note that instead of just releasing loans, no, they're mostly dealing with different securities. Another type of transfer between user and the provider of funds, also an indirect transfer, is through financial intermediaries. No? So financial intermediaries could be banking institutions, it could be private banking institutions, a government bank, or a non-bank financial institutions. So could be a private non-bank financial institutions or government non-bank financial institutions. Ano ba itong mga uh, banking institutions? So we have uh, the big commercial banks that we have. We have BDO, Metro Bank, DPI, government banks like Land Bank, UCPB, PNB. I think PNB is no longer government bank. So Land Bank and UCPB. Now, non-bank financial institutions could be uh, Cebuana, could be LLBC. No? Those that's now functioning as financial institutions. Government non-bank financial institutions could be your non-for-profit institutions. Okay. So financial intermediaries hire highly qualified people to assess risky investments. These know how to diversify money or funds to different investments instead of only to a single investment. No? So let's talk about diversification here. So remember, we have I'm not sure if you heard about this saying, no? Do not put all your eggs in one basket. So that simply tells us that we need to diversify. We need to invest in different um, in different securities or uh, investment opportunities and not rely on uh, one or single investment alone. So these have cost advantage or economies of scale, especially in the case of mutual funds. No? Cost advantage or economies of scale because there's risk involved, no, in terms of investing in mutual funds as well. Now, these help reconcile conflicting interests of users and providers of funds and give providers of funds liquidity, as in the case of commercial banks on deposits. Now, uh, when we say liquidity, basically this is the ability of an individual or organization to settle short-term debts. No, so your accounts payable could be uh, your payroll. No? So these financial intermediaries, like I said, like banks, can extend regular loans, no, in an instant. Just making sure that you have good credit standing. Now, going back to financial markets, these are generally separated into two, and these are short-term or your money market and long-term money or your capital market. So when we say short-term, and primarily it deals with securities whose life is less than 1 year. So in the next slides, we'll define or we'll try to understand what are the different money market instruments. No, so basically these are found in your current asset. No, whilst long-term market would be in your non-current assets or liabilities portion of your balance sheet. Okay, so then capital market is further divided into two. So we have primary markets and secondary markets. So for primary markets, it deals with the new securities, no, issued by the firm, governmental bodies, or other organizations to raise new funds. No? So later on, we'll also discuss about the initial public offering because basically that's primary markets. And then we also have secondary markets, so which are involved in trading securities already outstanding among investors. So these are where the trading happens. No? So if you're familiar with the Philippine Stocks Exchange, so that's a good example of a secondary market. So let's go back to short term or your money market. So this is a market intended for short-term placements. So again, it usually takes 1 year or less to mature. So we have your treasury bills, your repurchase agreements or reposition, your commercial paper, negotiable certificates of deposit, and bankers' acceptance. So treasury bills is an obligation by the national government. The interest is normally higher than the savings and time deposit. Treasury bills are regarded as risk-free investment because the payment of which are guaranteed by the government. During the pandemic, no, even before the pandemic, government would always issue treasury bills via commercial banks. No, the last time that I um, encountered this was with RCBC. Now, government, of course, they require funds. No? So one way to get funds easy for the government is via issuance of treasury bills. So this is also you can buy it from bank, and it is risk free because government is basically uh, guaranteeing payment of this. And as you know, government has the funds to pay for this. No? So that's the treasury bills or T-bills. Now, repurchase agreement. It is a financial instrument wherein one party sells a financial instrument to another party at a specified price with the commitment to repurchase that financial instrument at a fixed amount agreed at a specific date. So many repos have a maturity date of 1 to 2 weeks. So basically, class, repurchase agreement is giving the other party to the chance to repurchase it, but at a fixed amount and a specific date. No, so failure to pay that amount, of course, that party loses the chance to repurchase it. No? So that's the repurchase agreement. Now, what is a commercial paper? So commercial paper is an unsecured, so take note of that. It's an unsecured promissory note with a fixed maturity of 1 to 270 days. It is a money market security issued by high credit rating companies to raise money to meet short-term obligations. Isa-isahin natin to. So, for promissory note, usually it's secured, no? So, uh, it's secured, it's collateral. There is a collateral, no? But for a commercial market, it is said to be unsecured, but take note, this is being issued by companies with high credit rating. So paano ba natin na-establish yung credit rating? So basically, class, there's third-party institutions who are assessing the credit worthiness of the company. No? And so the reason why this promissory note could be unsecured is that these companies issuing the commercial paper have high reputation of or have high reputation, and at the same time they have the capability to pay it once due. So that's commercial paper. Now, what's a negotiable certificate of deposit? So it's simply a time deposit where the investor and the bank agrees on the term of placement. The investor may invest it in a span of at least 14 days to less than a year and is entitled to receive the agreed interest payment. So a certificate of deposit is between the investor and the bank. No? But I'm not sure if you have touch this on your taxation class, but in terms of certificate of deposit, in order for the interest to be uh, exempt from taxes, it has to be an X number of days. No, I'm not just too sure how many days it should be placed, no, in a time deposit. No? So but that's another subject matter. No? So basically, a certificate deposit, it's an agreement between the investor and the bank, and it will span of at least 14 days, no, and to less than a year, no, in order for a certificate of deposit to be classified as short term or money market. Now, what's a banker's acceptance? It is a bank draft where the bank is required to pay the holder at a specified amount on a specified date. It has a maturity of 90 days from the date of issue, but can be extended up to 180 days. No? So, banker's acceptance is simply a guarantee. No? So, imagine you're having a business dealings abroad. No? So with banker's acceptance, it's basically a piece of paper, no, that the other party is showing to the bank will pay. It's less risky compared to other investments because the payment, like I said, is guaranteed by the importer's bank. No? So the ones issuing it has already an account with the issuing bank. No? So it's kind of like a guarantee on the part of the uh, on the part of the seller, no, that it will be paid, no, at the specified date. So usually we encounter bankers acceptance in export, no, export and import transactions. Now, earlier we just a quick preview of what we've already discussed. No? So we've defined financial market, and then we also classified financial market into two. We have short term or your money market and long term or your capital market. Then we talk about capital market, and there are two classifications of capital market. We have primary market and secondary market. Now, primary market is where IPO is. No? Basically, IPO is an initial public offering. It occurs when a company issues stock in the public market for the first time. Very recently, I think it was one Nissin. No? So they're now offered shares to the public. Going public enables the company's owners to raise capital from a wide variety of outside investors. Once issued, the stock trades in the secondary market. No? That's what I'm talking to you earlier. No? So primary market, basically that's where the IPO is, and then once it has been issued in the public, it will now go through the secondary market, which is the Philippine Stocks Exchange. No? Now, public companies are subject to additional regulations and reporting requirements. No? So, uh, we earlier I've talked about different regulations that the government set to regulate the financial market. Of course, for public companies, no, in this case, uh, those trading via Philippine Stock Exchange, since there's a fluctuation on the price of the share, government various government agencies require these public companies different reporting requirements, like for example BIR and the SEC. They they require companies to submit quarterly and annual financial statements, no, and and just last April 15, I'm not sure if they moved it, no, but initially it was April 15 where audited financial statements became due. So auditors from big fours, no, they're really busy around that time. All right. Now, what is a secondary market? Again, this market provides liquidity to investors since he can trade his securities at any time. I'm not sure if you're aware how stock trading works, no? But basically, you will have a platform where you can see all the stocks that you have or you have purchased through Philippine Stocks Exchange, and then um, within the market hours, or when where the market is open, you can actually trade it, no, at any time. Now, secondary market is a financial market for trading of securities that have already been issued in an initial private or public offering. Now, we've discussed that. It sets the level of stock's price and therefore influences how much can be raised in future issues. So one good example of platform where we can do uh, trading or investing in equities or shares, no, is via Call Financial. I'm not sure if you're familiar with it, but you can Google it. In fact, um, it's very easy to get access to that, and then Right now, I think the market opens 10 a.m. to 1 p.m. only due to the pandemic. So it's a good exercise. In fact, there are lots of instructional videos on how to participate on call financials. No? So can also give you the link to that so that if you have time, it's good that while you are still in college, you start investing or you start studying on those platforms. So that's secondary market. Now, capital market, it is a market that trades equity and debt instruments with maturities of more than 1 year. There are two important elements of the capital market. No? So number one, organized security exchanges. So these are your Philippine Stock Exchange. Now, there's also another type, which is the over-the-counter market. It is involved in the buying and selling of financial instruments, but not in organized securities exchange. So it could be just between two uh, companies no, or individuals. Now, stocks, these are issued by corporations who would like to raise money in the financial market. The investors may invest in primary market or in the secondary market. Now, simply say stocks is your certificate of ownership. So when you buy a stock, say for example from Jollibee, you're technically an owner of Jollibee, but uh, not necessarily majority, no? So you're an owner as to the number of shares you own no, of Jollibee or from Jollibee. Now, the returns that are expected in investing in stocks are dividends and capital appreciation. So dividends basically you have the retained earnings, no? So retained earnings, the intention is to distribute it amongst shareholders. And capital appreciation is basically the increase in the price of your shares. So that's stocks. Now, what is bonds? So it is a long-term debt where the issuer is obliged to repay the principal at its face value on the maturity date and to make periodic interest payments until such time the principal value has been paid. So simply say that your bonds or your certificate of indebtedness. No? So the return from bonds are interest income and also capital appreciation. So we've talked about your money market and capital market, and there's also another type of market which is called foreign exchange market. No? It is a venue for the exchange of currencies. Normally, it is the bank, no, it's the bank who normally have this as one of their functions. So um, it's direct quotation when you're translating your local currency against different currency. So in our example, 1 peso is equivalent to 0.0192308 USD. And it's indirect quotation if it's uh, another foreign currency to local currency. So that's indirect. So in this case, 1 USD is equivalent to 52 pesos. Derivatives market. No? So financial securities whose payoffs are linked to other previously issued primary securities or indexes. It generally involves an agreement between two parties. No? So take note of that class. Two parties to exchange a standard quantity of an asset or cash flow at a predetermined price and a specified date in the future. So there are different types of derivatives. No? So one of which is your foreign currency hedging. No? Paano ba yan? So let's take an example. as an example, Xerox. No? So I'm employed with Xerox, and as you know, Xerox is a company uh, who manufactures photocopiers, no? And printers. No? So siguro, for the sake of illustration, let's simply say Xerox as the photocopying company. So we manufacture photocopiers. No? And of course, we have a joint venture with Fuji Xerox. Fuji Xerox is in Japan. No? So, and say for example, Xerox Philippines would like to order Xerox machines from Fuji Xerox, which is in Japan. So for 400,000 yen. So what we can do, so we can enter into derivatives market, or we can transact with a bank or another provider for a foreign currency hedging. So meaning to say, we can fix the value of 400,000 yen payable, say, by December 31, no, as early as now. So by fixing that, we can reduce the risk of paying more to Xerox, to Fuji Xerox, no, by December 31. What if, um, say, if it's in USD na lang, no? So the exchange rate right now is $1 to 52. So what if it becomes 55, no, by December 31? So with the foreign currency hedging, we're actually fixing the amount of conversion, no? So the amount of translation for the USD, so that we'll be able to mitigate the risk or the exposure of paying more because of the foreign foreign translations. No? So that's basically one good example of a derivatives market. And actually, that ends the first part of our discussion. So let's take sort of 5-minute break, and then we'll proceed with the second part. All right.